Hi, everyone. The Fed starts its meeting. It's turnaround Tuesday. Hello, Richard. Paul, how are you? Yes. Hi, Lowell. How are you? Long time. How have you been? Yeah, it's 5 a.m. here. I got up an hour ago. Came in. What's happening, buddy? Hugo and what you, Ryan?
Morning, Dale.
How are you? Sinatra.
Morning, everybody.
Everyone's
Stel.
Alexander, howdy, Alex, Brock, DJ. Okay, so what do you do in a week like this, guys?
You sit on your hands for a little while.
Yeah, and just wait for reaction after reaction. Look at what's happening.
You prepare.
Yeah.
Reduce position. Good morning, guys. Reduce
Yeah.
position size and get ready for the setups. And that's something I want to make sure we talk about today.
Okay. So, looking at the euro, I don't know, it's probably threatening this triangle if I drew a line. I think that there could be a rally, maybe back to, what Blake was looking for, 14.5. If it comes out here, 15. It could also go to, 111. So I don't know what to do in front of the Fed, actually. So, this surprised me that Canada looks like it wants to blow to new highs. Thought it was going to be like a little ABC and we'd pull back one more time. Dollar looks weak, some bad candles, and the yen looks kind of weak. So I don't know, makes me favor a weaker dollar maybe after the Fed. Maybe that's how we get to 95 that you're looking for, Blake. And, it's just not my style to trade it looking for it on a red event. So
yeah, I actually do think that first of all, we're just consolidating and we are obviously setting up, getting ready for tomorrow. And I think the market is, finding the, mid-range, if you will. And I think that's pretty typical of big events. I always tell people before, and you've heard me say this, you've heard me probably say this a bunch of times. You get a big event that people really don't know what to expect, or it's such a big headline that that you get the market mid-range, and that is very, very typical of these types of events. So, and that's why the FOMC, I think we're going to find ourselves in a nice. We are finding ourselves in a nice triangle ahead of that, and I think a lot of things are doing that as well. But Stelios, he pointed out this morning in our chat room that precious metals still trade really heavy, and that's something we have to take into consideration, especially when dealing with the dollar. As bullish as I want to be the euro, because here, let me just show you something really quick.
There's Apple. Apple finally exhausted itself. It got to 180. But I'll tell you, the rest of NASDAQ with NASDAQ 100 putting in a lower high looks vulnerable.
Where's it trading at right now?
What, the
Pre-market.
NASDAQ 100?
Apple.
It says 76.86.
Okay. Here, let me pull that up really quick. And Apple, which has been just on fire. I remember I talked to Katie Stockton last week, and she was talking about how bullish Apple was, and it was breaking higher. And then obviously Friday, Thursday, this is what we call dark cloud cover on Friday. So that was like that was a very bearish candle on Friday. Then
that's a 4-hour chart. That was yesterday, bro.
Okay, that was yesterday. Oh wait, then that is dark cloud cover.
Yeah,
we should have downside follow through today.
Yeah, so 68 maybe, and then it makes another run.
Yeah. So guys.
But Helen Meisler. You know Helene? Oh, you know Helene, right?
Yes, I know Helene. Actually, I'm gonna have a one-on-one with her tomorrow.
So, okay, yeah. So she's calling it the NBA market, Nothing but Apple. Pretty funny, isn't it?
That
Nice.
is funny. I like that.
Yeah.
But there are only a few select names that are dragging this market higher, and when that gives way, that's really gotta, you got to be kind of careful. Yeah. So, but let's go back to discussing currency. So this is like the euro, and this is the triangle that I'm monitoring right now. And you can see we are just mid-range. The problem that we have here is we have a little over 24 hours before we get this FOMC, decision. And there's a risk that we break out ahead of that based on, this triangle here. We could very easily break out of the triangle and give a false break, or not even a false break, maybe even a lead in ahead of the news, because as you can see, the apex is tightening pretty good. So, if you imagine this being a 4-hour chart, which it is, you imagine this over the next 10 to 12 hours, we could break higher, or break lower, right?
What's the formation measure to the upside, Blake?
Well,
it breaks
depends.
out.
It depends. So your maximum breakout is going to be like this, which would take us towards 115. Well, actually, this or this, either one.
Okay.
I mean, but I always measure it from the farthest points. That would be your maximum. So, this would take us back to 115, which this is
way back. Yeah.
Well, yeah, and this is also had been my target for the long side. For here's our patterns in play, by the way. Yeah, so this pattern in play was put in on the
look at all that green.
Yeah, that doesn't always happen. But it is right now. That doesn't always happen. If you guys look at the close patterns in play, you can see that we are right about 52% of the time.
Oh, that's the wrong page.
No, but hey, look, dude, if you guys are out there thinking that it's always rainbows and unicorns, it's not. That's
but this guy on Twitter has like a 95% accuracy rate. Come on, he must be telling the truth.
He must be telling the truth, right? Anyway, you can see the euro dollar. This was put in on the 7th, so it was exactly a week ago. And it's basically the long-term 618 fib that we are at, that we're testing. And that was important to me, for a big major.
Yeah. You hit that on the button live here in F.A.C.E.
Yeah. It was a big weekly, support. And I expected that to give us at least a bounce, and it has thus far, but we're more or less consolidating here. But my target would have been, and still is, by the way, because I've got to leave it. It is patterns in play are
guidelines
and formations and setups, right? Like how we trade those are really different based on, like, here in the trade room. You can see exactly what I'm doing when I say, hey, I'm closed out the cable here, and I picked up my euro, and I picked up euro and Aussie yesterday. You can see I averaged in some euro and Aussie yesterday, and I sold this morning what I bought yesterday. So, that's
you're scalping around your biases.
Yeah, that's in the trades room in the ForexAnalytix community, and that's going to be different than a pattern in play. This is just basically a setup, right? So the reason why I point that out is because I'm buying the euro down here, selling it up here, or selling it inside of the triangle. But ultimately, if this is a 618 retracement, which it is longer term, I am expecting it to bounce back to 115, which is this descending trend line and breakdown point. And based on your question, Dale, you asked, what's that target? Well, coming out of a triangle, it's going to take us right to that trend line. A lot of
confluence there, buddy.
There is. If we move higher, now I have to say this, and Ryan and Stelios, before we move into some precious metals, and I want to show you guys, how we're viewing equities right now too. But let's just finish discussing the euro and maybe some of the other currencies out there. I actually think that the market is very, very convinced that the Fed is going to be really hawkish tomorrow and continue to raise the amount of tapering that they're going to do going into 2022. And I think the market is very confident that the Fed's going to do that. That the Fed is going to, pick up the pace of tapering. And I'm not so sure. I don't know if everybody forgot who Powell is and what he's capable of. He is a hawk. He is a dove. He's everything in between. And so I think that you could say he's turned hawkish and he's gonna do this no matter what. He's gonna raise rates. But he is a buy. But the fact of the matter is the market is pretty damn confident that Powell is going to raise, and the FOMC is going to raise the amount of the taper process. They're going to fast. They're going to quicken it up.
You wouldn't tell looking at yields at the moment.
Yeah. So let's discuss that a little bit, because the reason why I still think this is very possible is maybe the Fed doesn't increase the taper as quickly as the market expects. And so what would happen? Well, equities, in case you missed it, the S&P is literally, even though we're down a little bit this morning, we are less than 2% away from all-time highs. You have the euro dollar that is really on a very key technical support, which could easily squeeze higher on a not so hawkish FOMC. Now, remember, the FOMC can increase the amount of taper. They don't have to increase it to 30 billion, which the market is currently pricing in. And dot plots too. The dot plots obviously are mattering. They do matter, as we discussed yesterday, because it's going to, kind of tell us how many potential hikes we could expect in next year, which the market's looking at potentially 2, possibly 3. So, I look at the euro and I think the market is pretty dead set on feeling the FOMC is going to be hawkish, but the euro stopped going down. The dollar has stopped strengthening near term. And so the risk now is they are not as hawkish and the dollar succumbs to some selling pressure, which, look, I'm still bullish the dollar and I still am while we're above 94.50, but I still think there's a scope for us for a little bit of a pullback. So, Ryan and Stelios, before we move on to like precious metals and the stock market, let's talk.
I have some views on Powell.
Yeah. Let's talk about Powell. Let's talk about what it can do to the dollar. And so, you first, Stelios, go ahead.
Speaking about Powell, we've said before that, look, this is the chance for the Fed to do something, to actually start tightening however much they can, because this is the window of opportunity. Inflation is high. Earnings is high. Everything is pointed towards them being able to hike. The problem I have is this. First of all, the Fed need to regain some of their credibility. They've lost a lot of credibility with their transitory malarkey and all that. The problem I have is that Powell just got reappointed, right, for a second term. Now, we all know that the Fed is independent and everything, but, there's a lot of political play in there, and the Fed chair always has a lot of political pressure. Yes, they're supposed to be completely independent, but we know it doesn't work like that. So my view is Powell is theoretically, or should be, hawkish, but you can bet there's going to be a lot of pressure for him not to be, because what the governments want and the Treasury and everything. They don't want to have 5% 10-year yields, because then the debt starts to become unsustainable, actually well below 5%. So that's my problem. That's why I think that Powell could be more dovish, although really he shouldn't, because everything is pointing towards this is the opportunity. End of story. So that's why I think you're absolutely right. You're saying that the market is like one way now. Everybody's convinced they're going to go to 30 billion, and yes, they're going to bring forward hikes. What if it doesn't happen? That's the big problem. I think the market's going to get spooked, and the dollar is going to crash, and equities are going to go to all-time highs within a day.
Yeah, I mean, it's a thing, and what's it going to take to push markets to all-time highs. And let's not ignore the fact that, we are in a seasonally strong time for the markets too. And I've actually, with Traders Summit, I end up talking to a lot of people, and a lot of people are very convinced that we're not going to see a Santa Claus rally this year for whatever reason. I don't know. I'm anyway. Thanks for your input, Stelios. So let's hear from Ryan. What do you have to say, Ryan?
Yeah, I'm in agreement with Stelios. I agree with you also that I think we're now priced the Fed acting. So how much more room has there got to be can be on the dollar side? We know he's dropping transitory. We know there's a potential for increase in the taper, and we haven't moved. And we've had that through the two testimonies. A couple of weeks ago, we've come all through all that news, and we haven't moved. Euro dollar is still 112, 114. You can call it. So we are priced. So the risk is that they're not as hawkish as the market expects. But I'm not sure. I think it's a bit disjointed. I don't think all the market is expecting. I think we've got the difference between analysts expecting and people who are actually pricing things. Because, as I say, look at yields. Yields aren't looking like they're expecting a fast taper or quicker hikes. Below 1.5%. That's not a level you tend to see when a major central bank like this is going on a hike cycle. So it is going to be difficult. I think for trading it, we need to sit on our hands and plan. One of the trades I'm going to be looking at potentially is a cable trade. If we do get a hawkish Fed, that's going to send cable lower. The market has pretty much ruled out hikes or any sort of hawkiness from the Bank of England on Thursday. I think that might be a bit misplaced, or at least it gives a decent amount of risk to the market being wrong on that. And if they're not wrong, they're not going to go dovish. So it's going to be a more of a cautious tone. I think that potentially is a.
Can I ask you a question about that? Because you talking about the sterling here. The sterling is also at a 38% retracement of the post-COVID move, and we've been drifting lower in the sterling, and we've been bearish here. But do you get bearish down at these levels? I mean, what do you think? I mean, technically, and I know I'm listening to your more of a your view on how you feel about the Bank of England, but how do you feel about the sterling here?
Right. If we didn't have the FOMC and the Bank of England this week, then as per last week, my view hasn't changed. We've got a big, strong levels down here. We've got those weekly MAs. We've got the monthly MAs. We've got the FIB down here, all around this 31, 50, 80 area. Yeah,
that's 161% extension of that last leg higher the last big leg higher we made to the 200-day moving average. 161% extension, 38% retracement longer term that I showed you. I mean, I don't know if I'd want to be short down here, but I'm sorry, continue on.
Yeah, so from a technical basis, there's some big support here. When you look at weekly MAs, it's where it closes, and we closed a week above it. That's solidifying the bottom for me. So what that does technically is it sets up two things. Either we're going to bounce significantly from this level, or we're going to break it. And if we break it, then potentially we're going to have a significant break. So that's a trade to go with. Go with a break. My big level down here is 130. It's a psychological level, big round number. If the Fed tip us down there, so step back. Looking at it technically, if we didn't have the Fed and the BOE, then you've got a good technical setup. Because we have got the Fed and the BOE, I don't put as much faith in the lines on the chart, because big news, no one's going to
lines ain't going to matter. Technicals aren't going to matter, right?
But they will matter after. If we break this big level here around 130, 150, 80, what happens after is important. If we go down to say 130s, bounce back up to that level, and we find it's becoming resistance, then we've got a range on our hands, and then we've got something else to trade. So if you feel like staying short, that's where you lean on. So that's going to be my trade. It has to tick all the boxes. If the Fed does send the dollar higher and cable dumps down towards that 130 level, I'm going to be very interested in picking it up to run into the Bank of England.
So, so just so you guys know, I don't have any sterling longs anymore. This morning, you can see right here somewhere. I have to look at we're in the trades room and when the ForexAnalytix community, I closed out the cable here. And I've been long for the last few days. I I've showed you the reasons why just moments ago. This is the trades room, by the way. Here's the general chat room, just so you guys can kind of see. This is the ForexAnalytix community. Just moving that over. So I've been long down here, on the approach below or at 132 basically, and I was actually scaling in as we were approaching 132. I bought a little bit below 132. I think my average was like 132. I forget what I just said there, 132.10 or something like that. I sold it this morning because, it's like I'm just reducing positions ahead of tomorrow's event. But you're right, Ryan. I mean, if there was no Bank of England, if there was no FOMC this week, I would be long here, stops below, 131. And targeting 135, 136, 137, but technicals aren't going to matter tomorrow. They aren't. They can set you up for risk and managing risk today and ahead of the event if you want to be in positions ahead of the event. But what I'm trying to do at this stage in the game is just take my profitable positions that I have and move stops to break even. So this way, I go into it. I don't want to say riskless because your stops can still get trade through them. But get to a point where you're really reducing risk to very little. I just saw that Steve popped in, so I'm going to get his comments here in just a second. But look, we've had this discussion about here we go with the Fed and the Fed possibly going to raise rates moving into 2022. And I know Steve has his stance has been that the Fed's never going to do it or never going to get close to it. But here we are, with the market starting to think that. So I'd love to get his views in here in just a minute. But what I also want to point out, before we do that, is I want to point out precious metals, because we were having this discussion about precious metals and how heavy they are trading. And Stelios, you were just mentioning that in the chat room. And look at the 200-day moving average in gold. We can't even get above that. We haven't been above that in the last week. We've been trading so heavy. And silver is, and here, let me remove that. That was a talk that I had yesterday. If we break above that, I feel that silver is going to, finally get out of this range or move from the bottom end of this range. But obviously we still need to break 2260, 2270 to do that. But look at how heavy silver has been. I mean, this is one of those things that I have a hard time because I am shorting dollars right now. I'm long euros, I'm long Aussie. I'm shorting some dollars here. I have a hard time doing that when these precious metals can't get out of their own way. And as you can see, gold and silver are hitting lows on the day right now. Here's, they must be listening to the F.A.C.E webinar. I'm joking about that, but how do you feel about precious metals here, and why are they underperforming so much?
I personally think it's all about the markets. It's always the immediate reaction to anything hawkish or tightening. Yes, oh my God, they're going to bring forward the taper and they're going to be hiking rates. And I've said this over and over again. All these factors, they can move gold and silver, but in the very short term. In the medium term, and I'm talking about 2, 3, 4 years horizon, if anybody trades that way, then all these are irrelevant because you've seen the dollar go up and down, yields go up and down over the years, and gold is if you look at the multi-decade chart, it's just going up. So and you're right. As long as we stay above like 1300, I don't think there's any reason to be bearish gold. But here, as far as technically tomorrow, I got to point this out, and let's go into silver. I think is the best setup. There's 2170. We've been writing down that as being support, like since we are way over here. We tagged it last week almost to the penny. And that's really critical support here. If you look at, silver, we haven't been, minus that spike low right here in September, we have not been below, let's just call it 2150. And, since, you have to go back here to July of 2020. So just watch silver. We get much below 2150, 2140. The bottom's going to fall out. There's a big, there's a big, kind of air gap, if you will,
somewhere below here, let's call it 2150 to 20. I mean, that's a big move too for silver. If we drop towards the big figure 20, you're talking about an 8-10% drop from current levels. So that's something to keep an eye on. And gold, gold could very easily see these levels that we haven't, these spike lows that we have back here. There's so many bulls in precious metals. I still feel that, some of these, especially like you take the 618, retracement here in gold, which will be right around the 1750, 1760 level. We gives way, we might trade lower, especially if silver starts to break lower. So that's just something.
So silver took out its flash crash low and gold's still way above it.
Yeah. I mean,
Made that back in August, that flash crash.
Oh, this one right here. Yeah, we are. Yeah, that's correct.
And gold's not.
Yeah, you still have the October lows though.
Yeah,
it's October, September.
Yeah. So I just think we have to keep an eye on precious metals. I've been saying this for months, and I know it's kind of, I don't want to talk it to death, but they have really acted poorly, and I think a lot of their weakness has to do with diversification in the cryptos, into the crypto space, taking a lot of the demand away from some of these precious metals. But flip side of that is, if you guys want to be bullish precious metals like silver, we break above this 2250, 2260 level. That means we're holding support. You could probably play this right back into the range. And this is where my red arrow came from, that I'll draw it again. You can play it back into that range. And then you have, gold, which, you start breaking above 1810 and, we get back above here and we might trade back up towards 1850. But that would be that'd be on a more dovish Fed. And you don't see the dots moving tomorrow, and you have like I said, you have a dovish Fed, and the dollar gets pounded, stocks go to all-time highs, and you're going to see these precious metals bounce as well. Hey, we got a few minutes, and I'm sorry, Steve, I wanted to, if his mic is here or his mic is on, I wanted to get his opinion really quick. Steve, you hear him a lot during the Morning Edge webinars. He goes through a lot of different instruments, but he Steve, you've had an opinion about the Fed. Do you think they're for real going into this next year? Do you think the Fed's actually going to make a move?
Good morning.
Good morning.
Morning, Stevie.
Hey, Dale. I think, Blake, that the Fed has already decided that they want to go through this because they've already received the nod that politically now inflation is a bigger problem than a stock market pullback would be. But I think there is a limit to that, meaning at some point this is going to cause another type of mini crash. And I think that once again, when that happens, they will, without much thinking, sacrifice, any inflation targeting for the stock market. So it's all about how long the market will allow them to go through this. Personally, I think that there is a good chance that they will manage to go through tapering. Now, having to do with hiking rates, I'm a lot more skeptical about it. And even if they start the process, previous time they did that, the wheels, went off the bus at 2.5% rates. Since then, we have a much weaker economy. We have a lot more debt. We have much bigger deficits. I think that even if they start the process, which I'm very doubtful they will, but even if they do, I think that this time the limit is going to be lower than the 2.5%.
Okay, so you feel like the Fed now you feel like the Fed could move, but they're going to be very limited what they can do because of the negative impact that you're going to see.
I think that's I'm not the only one that thinks that, because if you look at the bond market, in my opinion, what the bond market is more or less pricing in is that if the Fed is serious about it, it's going to lead the economy to the next recession. Having said that, it's not my opinion that the Fed should not be hiking. It's my opinion that the Fed is extremely overdue in hiking. And we've been saying that for years, that the cost of postponing the inevitable, which is actually normalizing the way an economy functions, will will have dire costs in the end,
10
right?
seconds to the data, just by the way.
Okay. Oh,
PPI.
thanks.
Let's see what we have.
I'm alive today.
Let's see
Thank
what we have.
goodness. Holy cow. Whoops. I'm
And
going
they're off.
to open the data flash right here. And thanks for your thoughts, Steve. Appreciate that. And we have Luke Groman's going to be coming up here in just a moment with Dale, but let's take a look at the data that's coming up and let me.
It's hot.
It is hot.
Yeah, what a surprise, huh?
BPIs, look at it. Let's, the dollar should be popping here.
What a surprise.
9.6 year on year, up from 8.6. Nothing to see here.
Yeah.
Wow.
Goods
Yeah,
increased
9.6.
1.2% in a month.
All right. Well,
9.6% in a year. Just imagine. Just think about that number.
yeah, well, I think that's going to be a good topic of conversation for Dale with his guest, Luke Groman, today. And by the way, I'll just say that I'm a pretty big fan of Luke's. I learned about Luke, even though I followed him for years on Twitter. You read people's stuff and you're like, oh, it's great. He's a great follow. And then I started really reading his stuff when I was, for the 5 years I was, or 4.5 years, I was doing some proprietary trading with the guys out of New York, and I was reading his newsletter all the time. He is such a great store of knowledge, and you guys are going to get a lot out of today's interview. So make sure you guys visit our webinar sponsor, which is Forest Park FX. They are like the concierge of FX brokers. If you are looking for a broker, you're not happy with the one you're with, contact them at the very bottom. There's a you can chat with them live here on Skype, or you can send them an email. Brokers at ForexAnalytix.com actually goes to them directly, and then they like I said, they're like a concierge. They'll handle you one-on-one. They'll ask you, what kind of type of trader are you? And, do you qualify for cash back rebates? Can you qualify to get ForexAnalytix for free through your trading? They can handle all that type of stuff. So make sure you deal with them. We've been partnering up with them for about 5 years now. They're a great group of individuals that are really work in your behalf. So anyway, enough about that. Ryan, Stelios, Steve, thank you so much. Dale, have a great interview. And good luck today, guys. And remember, today's going to be probably one of those days where we're consolidating ahead of tomorrow. Don't forget, we will be here tomorrow to take a really, really detailed look at the markets, get you set up with all the levels ahead of the FOMC. So we'll see you then. And Dale, it's all yours.
All right, good hunting today, Blake, and the rest of the team. Thanks very much. Luke, welcome back. This is your kind of environment. You want to show your mug, or you didn't shave?
Oh, absolutely. Today? No, I did actually. Absolutely.
All right,
hold on.
I didn't. So we could do a talking head interview. Nice to see you, Luke.
Good to see you, Dale. How are you today?
All right, I'm doing good, and what a great time. When I put these schedules together, I don't really think about events surrounding them when the guests will be here, but this is your bailiwick. So why don't we get it out of the way? What's your view of what Powell's going to do and say tomorrow?
I think he's going to continue to lean hawkish and talk about, especially with this PPI number that's coming out that you guys were just talking about. Politically, I think Blake nailed it on the head, or maybe it was Steve. But inflation's become a political issue, and quite frankly, I've been surprised how quickly it has been. But I guess that's midterm politics in America for you. And so I think he now has the political clearance to do that. I think it's the wrong thing to do. I think he's going to regret doing it. I think it's going to blow up in his face spectacularly. Probably, maybe as early as the first quarter of next year, late first quarter of next year. But we'll see. But I think he's going to lean more hawkish.
Do you think it's possible? There was a big question whether he'd be renominated or not. Do you think that perhaps Biden accepted that he'd rather have, if there was going to be any kind of tumultuous market reaction to it, to get it over with now, so that maybe by the fall, where the markets are recovering, into the election, rather than delay it and have it tank into next November.
Intuitively,
think that's part of it?
It's possible. Intuitively, that makes sense to me. I don't have the connections in Washington to say one way or another with any.
You don't have a red phone on that desk. Come on.
But intuitively, it makes sense. That's how I would try to manage it. I mean, there's no easy way out of this, and so it's a very political process, and that makes sense. If you had to try to do it, try to do it now. I would tend to agree with that.
Okay, so let's talk about your concepts in the forest from the trees. Okay,
sure.
And your concept of everyone thinks rates are low, and that zero. If we came off zero, it would be a big deal. But for you right now, rates are still relatively high considering the conditions that we're currently in. And you think there's a lot more room for major moves in the negative direction. And maybe that's the scenario that happens. Maybe the 10-year gets to 2, and that's just too much pressure on everything, and it reverses up there. What are you thinking, Luke?
Yeah, I think there's sort of two games being played at the same time, right? It's the short-term inflation political game and the implications for rates and what the Fed's doing that we just talked about. And then there's this bigger picture game, the forest for the trees, if you will, which is we are in a bursting global sovereign debt bubble. If you go back over the last 20 years, we had an equity bubble. It popped. We kicked it upstairs to the banking sector via a housing bubble. It popped. That problem was kicked upstairs to the sovereign level via the bailouts and backstops of virtually everything by the government. And so now we have this sovereign debt bubble around the world, really. It's really concentrated in the West and advanced economies because at the same time, the demographics of the baby boom generation are leading trillions, tens, hundreds of trillions of off-balance sheet entitlement promises to come on balance sheet. And just the sheer scale of this debt is sort of the forest for the trees view, which is to sustain this, you need significantly negative real interest rates. In other words, in a perfect world, 9.6% PPI with 0% Fed funds, that's perfect. They would, I think, absent politics, they would love to see PPI at 10 to 15%, Fed funds at 0, and the bond market sits still. They don't have to do any yield curve control in any real way, which traps them essentially permanently. And they inflate this thing away over 5 years. And in 4 or 5 years, we wake up that the GDP is at 70, 80%. And then the Fed can take the 10, can go into a true normalizing cycle. They can take Fed funds back to 2 or 3. You can get the 10-year out to 4 or 5 and nothing blows up. And I think that is the ideal situation. And I think politics in the short run, this shorter term game are interfering with that. And so ultimately, I think real rates have to go to probably -10 to -15%. And the reason I say that is if you look back in history, the last time U.S. debt to GDP was as high,
World War II.
Right after World War II, and you saw U.S. real rates went to -14 at the Fed funds level or at the T-bill rate, and that's not even the worst of it. I mean, if you look at nations that were more destroyed by the war, Japan, Italy, France, Australia, they had real rates anywhere from -30 to -60%. So you had extraordinarily high inflation with 0 rates for anywhere from 3 to 5 years, and you got out of the debt. And I had thought that this emergency was a big enough emergency that it provided the political cover, like the war did, to basically screw bondholders on a real basis.
It's another war.
It's another war, right? You've heard policymakers talk about that. I've quite frankly been surprised how little political currency COVID has had over the last 3-4 months. It basically, we're right back to inflation fighting, which I understand why they have. Well, why the politics of it are, but it's the wrong thing to do with that where it is.
Yeah, Paul's even using COVID to build his case, saying that the labor force and the constraints we have with trade and having our supplies being held back is lack of labor. So that COVID actually exacerbates the inflation problem.
Yeah, and that's something too this time that makes
different.
And it's different. It's very tricky for the Fed because you have the COVID labor situation, which the Fed can't print labor. They can raising rates probably isn't going to help it, unless there's a lot more people getting rich in crypto and stocks than we think. In which case, if they take hits on their portfolios and have to go find a job, but I think that's probably a tail case. I don't think there's 5 million laborers out there that are rich on crypto now that will have to go find a job if crypto gets killed because Powell raises rates a few basis points. But that's not the only issue in terms of sort of this stagflationary impacts. I mean, you're seeing a lot of signs of what we write about as peak cheap oil and gas, which is not to say we're running out of oil and gas, but demonstrably we are running out of the cheap stuff. And
Right.
to continue increasing production, if you want the economy to grow, you need to consume more energy. That is still oil and gas primarily. And if you want to increase production, you've got to increase exploration. But the costs of this stuff are higher. So Fed, thinking that they want to constrain inflation, they're going to raise capital rates, hurdle rates on this expensive oil and gas, which means it's not going to be produced on the margin. And so when they're actually thinking they're going to be reducing costs, reducing inflationary pressures that we're seeing from the energy sector right now, for example, they might actually be making the problem worse by raising rates, which again is something we've not seen in a very, very long time. And you're seeing this in other areas as well. You're seeing, battery prices are starting to rise for some of the electric vehicles, again, due to some of the ore grade constraints,
I saw a guy tweet, Luke, who said, I just ordered a new refrigerator and it'll be delivered in August. And with the tragedy with the tornadoes, a lot of transformers were damaged, out of commission. The guy's talking about it could take months, and you know why? We don't manufacture them.
We don't make
they're
them.
in China.
Yep, they're in China, and China's having constraints, right? If you look, China's been shutting down power plants, and some of that is increasingly looking like it's a water issue. That basically everyone's known China's had a water issue forever. Everyone knew it was going to be acute someday. Even a number of Chinese policymakers were saying it's probably going to be acute within 10 to 15 years. And they were saying this in 2010, 2011, 2012. So here we are 10 to 12 years later. And you're seeing, they've got a lot of hydropower there. And so if you just take some of your marginal electric capacity off, it ripples through. And so there's a lot of factors here that the Fed can't do a darn thing about in terms of inflation and inflationary pressures. And
they can't print grain.
Worse.
They can't print grain either. I mean, you look at the agricultural commodity markets, and they could take short-term rates at 20, and it's not going to break supply issue with a drought or just short crops. And I want to really move to what's going to exacerbate this problem. And I want you to explain why I'm thinking technically. You give me the fundamental argument before. For this. So, I'm expecting a high in the dollar between 98. Some people I'm looking at 98. Some people a little higher, 100. And the resumption of the long-term downtrend in the dollar. And I actually think that might be one of the biggest trades of the year, that there could be some type of run on the dollar. And this has just been a bear market rally from last January because the whole market was wrong-footed. Why and how can we have a bear market in the dollar in 2022?
Yeah, I think I think that makes a lot of sense, and I think how that could happen is you get the Fed addressing inflation for political reasons here in the near term. And then that forest for the trees, big picture debt issue manifests itself. And I think the way it's going to manifest itself is not just in the equity market, but more importantly in the Treasury market. I think the Fed in March 2020, if you go back and read what they said from March 2020, really through much of last year, they effectively took on a third mandate quietly. It was full employment, low inflation, and making sure the Treasury market functions properly, avoiding Treasury market dysfunction. And
well, they've had lots of fires to put out during that promise, haven't they?
They
Repo
sure
markets, etc.
Yes, they have, and I think that's everyone's been watching. Where's the Fed put struck on the equity markets, and I think that's a very valid, and I continue to watch that myself. But for me, the most sensitive metric is where's the Treasury market put? In other words, where has the Fed, where does dollar liquidity, where does the dollar trade to? Is it 98? Is it 99? Is it 100? I think that's the right range. At 98 is where I'd be looking to start for that to happen. But where's the dollar rise to where the Treasury market starts to have problems again? And the Fed has set up some programs to try to ameliorate this, standing repo facilities for domestic investors, domestic institutions, some foreign swap lines for some foreign institutions. All of those things would effectively be the same as reinstituting QE, just on a sort of day-to-day basis, as needed basis. That would begin those programs, if they began being used, would effectively mark a top in the dollar. They would be capping the dollar with usage of those facilities. And so I think when you think about fundamentally, how could we look at a world where the dollar gets to 98 to 100? I think 98 to 100 is where the Treasury market starts to break in terms, again, of its functioning, right? Where you start to have these bad auctions, et cetera. And the Fed's just not going to let that happen. Full stop. And I think we move then to usage of some of these facilities. And if that doesn't work, then I think we move back to some sort of resizing, re-increasing of QE. Yeah, I think they do QE first. I think they're very, very reticent to go to negative nominal rates, but I think you'll see another 2-3 trillion in QE, some big number that really shocks people. And I think there will be an aha moment as it relates to how the dollar trades. I think that will be this big aha moment where I think a quorum of market participants go, oh my God, they really are stuck. It used to be, in 2016, the dollar went to 103 and things broke. And then it went to 100 in 2000 and it broke. And then it goes to 98. So you're having this declining peak where levels of the dollar where things break. And that's just a function of the debt rising exponentially. And I think that's fundamentally, quite frankly, what you lay out there, I think that makes a ton of sense. I could see absolutely how that would play out.
Well, what fiats would you be attracted to should the scenario change? Obviously the classic would be to be moving into euros because it's a big part of the dollar index. But could there be some currency trades or positions in some of these markets and economies that have been stressed out by a strong dollar because they've denominated their debt in the dollar, and if the dollar comes off, that they'll have a tailwind in their economies instead of a headwind?
Yeah, I would think in terms of, I guess, two buckets. First bucket would be those that were just really, really bad shape. Twin deficits, dollar debt, Turkey, Argentina, right? The ugliest of the ugly, right? Guys that are moving towards balance of payments crises. If the dollar got much weaker, the Fed reversed, they would just be a counter move right there, which is probably very high beta, et cetera. That's sort of the risky play.
Yeah. That's for people that are suicide traders.
Right. There's not a lot of fundamentals backing that. Now, in terms of something where I think there would be not just a reversal of the dollar strength that had hurt them, but also a fundamental driver to it, would be perhaps the Mexican peso. Where you're already seeing. Last week I thought it was really interesting to hear Secretary of Treasury Janet Yellen say the inflation is not going to stop, and we may need to we may need to put some protectionist metrics up to reshore manufacturing. Well, if manufacturing is coming back, and there are a lot of indicators suggesting that it is for a number of political and I think geological, just resource related reasons, I think no small part of that's going to end up back in Mexico, where it was from 94 to 01 after NAFTA was signed. So you could have a renaissance of sort of the 94 to 2000 timeframe for Mexico in terms of manufacturing moving out of China into Mexico being sort of a long-term tailwind at the same time that the dollar was weakening.
Yes.
And so that would be interesting to me. I think you'd also want to look at a number of different commodity currencies, probably the Canadian dollar, maybe the Aussie dollar as well, I think would be
how about the ruble?
Fundamentals.
How about the ruble? What do you say about the ruble, Luke?
If the sanctions,
should we wait for the invasion to buy to buy a break in the euro in the ruble? Wait for the invasion.
Left unsaid around the ruble and the sanctions, all this stuff. Nobody's pointing out that everyone likes to quote the quote. Russia's just a gas station or whatever John McCain said, right? Masquerading as a country. I routinely have people say, "Oh, their GDP is smaller than like Maine or Texas or something." Look, the reality of the situation is this: if you subtract Russia's oil and gas from the world's supply, we all starve and freeze. End of discussion. And certainly Europe and China freeze and starve. And so
it's a lot of leverage.
It's a lot. He's the most powerful man in the world.
That kind of leverage,
That's exactly my point. And so when you translate that to the currency markets, you have this currency that is in the best fiscal shape of anyone in the world, bar none, right? They've got very low foreign debt. They've got massive gold reserves as a percent of total reserves. They are the key swing player. They're the world's biggest energy exporter. They are being run by, whatever you think of as domestic policies, arguably the most thoughtful, strategic, best leader in the world. And so you have all these things on the positive side for the ruble against this sort of Damocles of, I don't want to be there when the Americans put more sanctions on him or if he does invade, because then I'm going to be wrong for the right reason, which, as traders, we don't care. Yeah. We just care about the first part of that statement.
Yeah. Okay. So, I'm wondering what level in the Treasury market do you think that we might, the Fed would have to throw in the towel? Yields at 3%, or is it just that the bond vigilantes, which are newer generation of traders, don't even know what they are, that they're the ones that are going to drive the Fed to the breaking point? And so it's interesting because I always thought they were more S&P sensitive, but you're right, the way they came in during COVID in all the bond markets, the corporate debt market and junk. And they've all been under pressure. I mean, the bond chart doesn't look that great to me, and either does HYG or LQD.
Yeah, it's one of these things where there's a discussion I always hear, well, it was just a plumbing problem. Well, as a trader, just a plumbing problem is just a nice way of saying the market crashed. Everybody was on the same side of the trade and the market crashed. And the Fed had to take the other side of it. And they've had to keep doing that. And it's a structural balance of payments, debt. There are some technical plumbing issues in there as well, no question. But in terms of your question of where's the level, I think there's two levers that they have. There's the absolute level, and if you hold one side steady on the fiscal side, is lever one is the fiscal side. If you hold that steady as she goes, then I think probably 175 to the 175 to 2 range in the 10-year is where you start to see problems. Okay. Now, practically speaking, we're seeing them throttle back the fiscal side a bit. You've got this fiscal cliff coming up. You had Biden just come out and say, hey, student debt is going to have to start being paid again. That's a tax increase. It's basically a tax increase in February. So you're actually seeing liquidity removed by that. And so I'm not surprised to see the 10-year doing what it's doing, because I think that's the right move is there's a bunch of anti-growth policies being put in place on the fiscal side. Now, by the same token, if they reopen the throttle on fiscal, then that gives you more leeway on where the 10-year can go, where Fed funds can go, until something breaks. And it really comes down to, again, that negative real rates issue. I think once you get to, negative real rates of, 50 basis points, 60 basis points on the 10-year, 40 basis points, we've been running into problems. And that's the real side, I think, is a function of fiscal, driving inflation on a lag, and then where the nominal rate is. So right now it just depends on how they set those levers. And like I said, it looks like they're throttling back fiscal, which gives us maybe even less leeway at the long end.
Okay, and you think about how well commodity markets have performed, Luke, and that's with the headwind of a firm or steady or strong dollar. And I've seen bear markets in dollars. It's not bearish for commodity prices. You get at least you get at least nominal gains, and it's not, at times it's not bearish for the stock market. You can have a 30% break. In fact, after some of the crises we've had early on, the first 30% of the recovery was a 30% decline in the dollar. So
Yeah.
you could also have nominal gains there.
Yep.
So I can only imagine what's going to happen to inflation if the dollar's weakening and we still have all these supply constraints.
I think the table is set for an extraordinary extraordinary bout of inflation at some point, probably in the second half of 2022, because these supply chain constraints aren't going away. When you look at something like China has water issues, that's a lot of this stuff is structural. Peak cheap oil and gas, Fed raising rates is going to make it harder to find more, not easier. When you look at the copper, when you look at the supply chain side, right, there's no more new container ships coming into the trade until 2024, 2025, best case, assuming there's no other delays. And so when you look at all of this and then you overlay, the 70s, we look at that inflation, US debt to GDP in the 70s was 25 to 30%. It's 125% now. There is no ability to let rates really rise to maintain even a rational or a modest negative real rates like we saw through the 70s. I mean, if inflation really gets away from them and the bond market truly revolts, I think that's their worst nightmare, because then they would be forced basically into some sort of explicit yield curve control. And you could see a really compressed period of extraordinary inflation in the U.S. If that's the case. And I think, unfortunately, that's probably a lot more than a fat tail. That's probably, I don't know that that's a base case, but there's a real shot of that happening, late 2022, early 2023. And it might be, we're sort of in a car situation, right, where they oversteered to the inflation side, and now they're panicking, and I think they're oversteering to the deflation side, and I don't think they're going to like that outcome. And sort of this secondary re-steering that we finally get the car to really spin and go into a ditch as it relates to inflation may be what happens.
Yeah, I'm really excited about the trading opportunities that I think are coming our way in 2022.
Absolutely.
Almost feels like this year was a setup for what we're going to see next year.
I think that's right.
Different areas. So
I think that's right.
I want to wish you and yours Merry Christmas and Happy Holiday, Luke. And I hope that we could talk again as what is theorized unfortunately manifests, and keep in touch and keep the narrative going. I appreciate that you educate people that what really negative rates could be, because most of us in our lifetime, I wasn't around in World War II, so
neither was I have to say.
Yeah, so and so anyway, it's a service that you give people your broad perspective. I encourage people to follow you. I receive your emails, and best place to do it is the name of your website. Is it Luke
Sure.
Roman?
It's FFTT-LLC.com. Yep.
Okay, Luke, thanks so much for sharing your time and edifying the F.A.C.E community today. Had a great time talking to you.
Thanks for having me on, Dale. It was great talking again. Merry Christmas to you and yours, and we'll talk with you soon.
Yeah, we'll talk in the spring. See
That
what's happening
great.
by then, right?
Absolutely.
All right, Luke.
Fun.
Thank you very
All
much.
Right. Thanks, Dale.
Everyone,
Take care,
Luke, everyone, Luke Roman, and you have to stay on top of it. Blake is a fan of yours, so he'll be getting in touch with you, I have a feeling.
Perfect.
So thank you very much, Luke.
All right. Thanks, Dale. Take care. Mm-hmm.
All right.
Bye-bye.
So everyone, that's a wrap. Tread carefully. You could join the team in 15 minutes for the morning edge and hear more of Steve Volge. That was a teaser just to hear him pontificate about the Fed. Sure miss that guy. Steve's like me. We're both real positive guys. Anyway, Thank you, everyone. Don't forget, if you want to do the $1 trial, you have to do it before our deal pops up, okay? I'll see everyone tomorrow. Adios. You're welcome, Alexander. See you, Paul. DJ, you too, buddy.